Welcome to Talk Tickers, your essential summary of the critical signals hidden in the earnings calls that matter most.
Today we're doing a deep dive into American Well Corporation, AMWL. They reported their Q3 2025 results on November 4th, and this is one of the most two-sided stories we've seen in a long time.
It really is. And our mission today is to unpack that central conflict for you. Is AMWL actually pulling off this huge transformation they've been promising?
I mean, they're trying to go from being a simple volume-based telehealth provider.
Right, just getting paid per visit.
Exactly. And shifting to this sophisticated AI-enabled platform business. The question is, are the new parts growing fast enough to offset the old parts they're killing off?
Let's start with that result snapshot because it really tells the whole story in miniature.
Okay, so on one hand, they beat expectations. Revenue came in at $56.3 million, which was a little ahead of the $54.4 million consensus.
And the profitability picture, I mean, that was a huge win for them, right?
A massive win. The adjusted EBITDA loss was down to just negative $12.7 million.
And you have to put that in context. A year ago, they lost $31 million in the same quarter. That is a huge step in the right direction.
A huge operational improvement. And losses per share, same story. GAAP net loss was down to negative $2 a share from almost negative $2.90 last year.
Beating the analyst estimates there, too. So all good news on the cost-cutting front.
But, and this is the big, but that explains the market's reaction.
Yeah.
That top-line beat hides a pretty crucial detail.
The absolute decline.
The absolute decline. Revenue actually fell year over year by about, 7.8 to 8%. So it's an efficiency story, but it's happening on top of a shrinking business.
And that's exactly what the market saw.
Yep. It completely ignored the beats and focused on the revenue shrinkage. The stock traded down something like 9% the next day. It just signals this deep, deep skepticism that they can pull this turnaround off.
Okay, so that reaction brings us right to the financial deep dive. Management is basically telling a story of deliberate amputation.
That's a great way to put it. They're intentionally shrinking the low-margin visit business to make room for the high-margin recurring software business.
So how's that working?
Well, if you just look at the subscription part of the business, it looks great. Platform subscription revenue was $30.9 million. That's up almost 18% year over year.
That's the good stuff, the recurring revenue.
That's what investors want to see, and it's fundamentally changing the company. Subscriptions are now 55% of total revenue.
Wow. And a year ago?
It was 43%. So that 12-point shift, that is the transformation right there in the numbers.
But the other side of that coin must look pretty ugly.
Oh, it's brutal. The traditional visit business is just eroding. Total visit volume fell 21%.
21%. That's huge.
It is. So visit revenue was down almost 23% to just $21 million. It's just lower use and, frankly, pricing pressure. Telehealth visits are a commodity now.
And what about the revenue per visit? That's going to be shrinking too.
Yep, down 14% to $71. Now, management did try to, soften that blow a little.
How so?
They pointed out that if you normalize for the sale of their psychiatric care business ATC, then revenue would have actually technically grown by about 1.3%.
Which is fair, but it doesn't really change the underlying story of the core visit business.
Exactly. Selling off assets makes the numbers look a little better, but it doesn't solve the core growth problem for the platform that's left.
But that strategy, selling APC and pushing the software, that's what's driving that incredible margin expansion we saw.
That's it, 100%. Gross margin went from 37% a year ago to almost 52.5% now.
15 points.
That is almost purely from swapping out low-margin services for high-margin software. And they're being incredibly aggressive on the cost side, too.
You're not kidding. Total operating expenses down 16%. And I saw they cut sales and marketing by 46%.
46%. I mean, they are doing everything they can to look and feel like a lean software company, not a bloated healthcare provider.
Which I guess leads to the big question for you, the listener. If the margin improvement comes from cutting and selling, how much more can they really squeeze out before they just have to grow the top line?
And that takes us straight to management's vision because they are betting the entire farm on AI.
The CEO, Ido Schoenberg, he was really hammering this home on the call, wasn't he?
He was. The message was, we are not a telehealth company anymore. He said implementing AI-driven care is not a question of if, It's really a question of how.
They're trying to own that layer that sits on top of everything else.
Right. They see this problem they call vendor fatigue.
Which is a real thing. A big hospital system is trying to juggle 5, 6, 7 different digital health apps. One for mental health, one for billing, one for chronic care.
It's a total mess. And AMWL wants their platform, Converge, to be that single integrated backbone that brings order to the chaos. The AI is meant to help navigate all of that.
So how do they make money off the AI? Are they charging for it directly?
It's interesting they're not, really. The monetization is indirect. The AI makes the whole platform stickier and more valuable, which lets them charge more for the base subscription.
So it drives up the ROI for their customers.
Exactly. And they also talked about a revenue share. So if their AI directs a patient to a third-party partner on the platform, they get a cut. They see as this high-margin flywheel.
And to prove this enterprise strategy is working, they pointed to one really big win.
A huge win. The multi-year contract extension with the U.S. Defense Health Agency, the DHA.
That's more than just revenue. That's a massive stamp of approval.
It's the ultimate proof point. If you can handle the scale and security of the military, you can handle anyone. It's their cornerstone reference client for every future sales pitch.
And this all fits into that theme of simplification. They said they're still looking to sell off other non-core assets too.
Yep, anything that isn't essential to that core Convergys platform is on the chopping block. It's a long-term thing, not an immediate catalyst, but the focus is crystal clear.
Okay, let's talk outlook. And maybe more importantly, runway. How much time do they have to make this work?
Well, they ended the quarter with a little over $200 billion in cash and, importantly, zero debt.
And the cash burn this quarter was what, 18 million?
18 million. So you do the math, they have a decent runway, but it's not endless. The clock is ticking.
And the guidance reflects that. They narrowed the revenue forecast for the year down a little bit.
But they significantly improved the EBITDA loss guidance. They now see a loss of 42 to 45 million, which is much better than the 50 million they guided to before.
But here's the show me story, right? The big promise.
This is what it all comes down to. Management is staking its reputation on hitting positive operating cash flow by the end of 2026.
And when analysts on the call push them on what's the number one thing you need to do to get there, what do they say?
It wasn't about new AI features or growth. It was client retention.
Just holding on to their current customers.
They're holding on because they're asking these big clients to go through this painful transition with them away from the cheap, high-volume visits. The biggest risk is that those clients just leave for a competitor who still does the old model.
And you can see that risk priced into the stock. I mean, the underperformance is just staggering.
It really is. In the last month, the broader healthcare ETF, XLV, was up over 6%. AMWL was down over 32%.
Wow.
Yeah, it just confirms that the big money, the buy side, they don't care about the internal story of margin improvement. They are focused entirely on the revenue shrinkage and the execution risk of hitting that 2026 deadline.
The consensus on the street is basically a hold, with the price target around $8.30. They need to see real proof before they'll bite.
Which brings us to our regular segment. This is not financial advice.
We have to say it every time. We are not advisors. This is purely a speculative thought experiment based on the story we've just laid out.
And the story for AMWL is just so binary. It's a knife's edge. If they pull this off and hit that 2026 target, the stock could, really fly. If they stumble,
the cash burn becomes a huge problem.
It does. But the interesting thing here is the implied volatility. It's sitting around 80 or 90%. The market is pricing in a massive amount of fear.
And at the same time, you have that $200 million in cash acting as a sort of a buffer on the downside.
A very real floor. So the outrageous trade idea here is to use that fear against itself.
Okay, I'm listening.
You could sell a slightly out-of-the-money put option. You collect that really high premium because volatility is so jacked up, and you're basically betting that the 200 million cash balance keeps the stock from completely collapsing.
Right, and then you take that premium you just collected.
And you use it to finance a bullish, long-dated call option or a call spread, targeting that 830 consensus price target sometime in early 2026.
So you're funding a bet on the upside with the market's own pessimism about the downside.
It's a way to get long-term upside exposure to the turnaround story, paid for by the short-term fear.
All right, to quickly recap this deep dive then, AMWL is a story of deep conflict. You have strong subscription growth and fantastic cost control on one side.
Battling against a legacy visit business that's collapsing in this really daunting 2026 deadline to get to positive cash flow.
And the market, for now, is not buying the AI story. It needs to see hard proof that the platform can actually scale revenue, not just cut costs.
Exactly. Cost cutting buys you time. Only platform growth buys you a future.
So the true test for AMWL isn't just about managing expenses. It's about how quickly that big DHA contract and others like it translate into real, measurable growth. And that leaves you with our final thought. What specific milestone beyond that big 2026 date do you need to see next quarter to believe in this turnaround? Is it subscription growth hitting 20%? Is it the visit revenue finally bottoming out? What's your number?
Thank you for joining us for this deep dive into American Well Corporation.
We'll catch you on the next Talk Tickers.